Welcome to your commercial-free, uninterrupted investment show, sponsored by the SEC-registered investment firm, Wilsey Asset Management, a fiduciary firm owned and operated by President Brent Wilsey, who has been putting clients' investment needs first for over 40 years. The Smart Investing Show has been giving unbiased financial information for over 27 years on local radio stations right here in San Diego, providing you with fundamental analysis on stocks and investments you want to know about. Now, here are your hosts, Brent and Chase Wilsey.
Well, hello, and welcome to the Smart Investing Show. I'm Brent Wilsey. Great to have you here on the Smart Investing Show. I am president of Wilsey Asset Management, and we are the proud investing partners of the San Diego Padres. And great to have you here on the Smart Investing Show. Got a lot to talk about today. We got the consumer conference came out this past week. Wasn't a big number, but we'll talk about that today. Apple. Could they buy Disney? That was rumored this week. We'll talk about that. And then also, back to cryptos. Binance, the last one we'll call it, still standing. Seems to be some cracks there. We'll discuss more on Binance in the crypto area. Chase, what do you got this morning?
Well, as always, you want to join the show. Phone number here, 833-288-0973. Again, 833-288-0973. Again, here to take those calls for you. Got a question about a particular company. We call them companies. You may think of them as stocks, but we'll be here to break that down for you. Or you got a question about the economy, financial planning type issues. We're here for that as well.
And today is April Fool's Day. We're not going to fool you on anything, but we also got to announce that today is Chase's birthday. So happy birthday. You got big plans today, I believe, right?
Yeah, we're doing a little brewery tour around the San Diego brewery places. We're going to AleSmith, and we're going to Duckfoot, and going to Harlan. So we're excited. It's going to be a good time.
Except for AleSmith, I don't even know those other places.
Yeah, AleSmith's a big one, obviously. But all I want for my birthday is the Padres to win tonight instead of continuing this losing slide.
yeah. It's only 2 games. So,
I know.
But it's like, tonight will be the night. So you're not going to the game tonight, are you?
No, we're just going to watch it on TV.
We were there last night. Thank you for the Padres for hosting us in their suite there last night. That was fantastic, and I wish they would have won, but it was a great time. So thank you, Padres.
They'll get it rolling.
Yeah, they'll get it rolling. All right, well, let's talk about the business side here, and let's talk about consumer confidence, because I was happy to see the consumer confidence number come in at 104.2 for March, which was up from February's 103.4. For me, this is another positive sign that we'll not have that major recession, and that consumers will continue to spend on goods and services.
I do want to emphasize this is a good number, not a great number. The reason I say that was from 2008 to 2012, the confidence number was below 60. But in 2019, it rose to nearly 140. So, again, about 40 points below where we were at in terms of the height. So I am happy with the current number for now, but it is something to keep an eye on. And I did have somebody actually on social media say, well, it wasn't a great indicator back in 2007. And yeah, you're right. But the big thing you have to look at was what happened in 2007 wasn't the collapse of the consumer. It was the issues in the banking system.
Correct.
So it's not enough just to look at consumer confidence, but it is one piece of the puzzle. You can't ignore that consumers still feel good, but you have to look at the whole picture. There are other issues out there, essentially, but this is one thing that, again, continues to provide optimism.
And that's one thing you say. You can't look at one indicator and say, oh, this is going to happen, that's not going to happen. We look at so many different things to look at that you got to do that, because that person, it wasn't a great indicator back in 2007. No, it was not, but there was other things that were a good indicator. I remember being on the news talking about real estate's way too expensive. Oh, you're just a wet blanket. No, it's a problem. You've got to look at all the factors. I mean, shoot, if it was that easy, it's like we wouldn't be working 60 hours a week, Yeah,
no, I mean, the other thing is it was a terrible indicator in 2019, but gosh, you would have known COVID was right around the corner as well. So
that's another one.
It's just there's going to be these black swan events, but there's the data that we need to continue to look at that could point to potential issues and potential pitfalls. Right now, this is something that, again, we talk a lot about consumers still having money. Debt has been increasing a little bit, but it's really, again, reverting to pre-pandemic levels. I mean, the consumer is still in a good spot.
Right.
Not a fantastic spot, a good spot.
And people say, well, if you got the COVID event, what's the point of even looking at the data? Because things can come out, the black swans can come out and destroy you anyways, because then you can understand how you're going to make it through that situation. And during COVID, what we did where people were like panicking and selling, and we were buying like crazy because we said, wait, everything else is good. We've got a strong this, we got that, and so forth. That was probably I believe my second best year in my 40 years as far as performance in 2020 for new money coming in. I mean, it was just a fantastic time to buy because you saw things on fire sales, and we said, okay, unless COVID kills everybody, we've got fundamentals on the economy that will get through it. So if you understand what's going on, you can weather those storms much better than just panicking and selling and getting out.
Yeah, and the other thing, too, is, who cares if, we're going to have... Well, first of all, COVID was like the worst thing since the Spanish flu in, 1918? I mean,
I think so. Yeah.
Years. And then also, we've had actually a pretty difficult couple of decades when you look at it.
Yeah.
In 2008, 2009, that was really the worst thing since the Great Depression in 1929. So,
yeah.
Hey, maybe we're due here for a good next 80 years or something.
But when you go back in history on investing, it's difficult because, you didn't live through it, but I lived through it. But back in, we had the great, 80s. That was great. But during the 70s, you had the Vietnam War. You have other things. And when you get the news, it's fresh in your mind. But I believe this is kind of like the norm of different things that happen. And that's with investing. That's why you got to focus on the fundamentals, because you're going to get all this outside noise. But at the end of the day, will consumers consume? And yes, they will at different levels, and you got to understand what those levels are.
I want to take back my statement about 80 years, because when I think back to it, it's like we talk again about World War I, World War II, Vietnam War. There's been a lot of different things.
Yeah.
But that's the thing, too, is there's always going to be this chaos. And I sound like a broken record here, but the thing that you look at is what has done well through all this chaos. Stocks.
Yeah. The numbers on stocks are just phenomenal. You go back to the 70s, and I don't think we did the post on this yet, so I'll just kind of blurt it out there. We'll get more exact numbers for you. But you go back to the 70s, and on real estate, like, wow, since then it's up like 900%. Like, wow, that's fantastic. I'm rich doing that. On the S&P, or actually on stocks, I don't know if it's S&P or not, but on stocks, 16,000%. It's far better to invest in equities, but the problem is people get emotional. They sell out because, we're going to have China this or the war or this or Pan. You can't do that. So,
hate to burst your bubble. That has already gone out in the newsletter, the post, and we did talk about it on the radio, so it's
good. Worth saying again.
It is worth saying again. It is important.
Well, let's move on to Apple and Disney, because this came out this past week, and there was talk this past week that Apple may be buying Disney. No numbers have been released yet, but I do not believe this will take place or that it would make any sense for Apple. Apple may be looking for the media side to help grow Apple TV, but if you buy Disney, you must also take care of the theme parks and the cruise lines, which, well, Apple has really no experience, or I feel no desire to get into that business at all.
They could also spin those off, but I think if they were going down that path, they would be better off to either buy like a Warner Brothers or a Paramount, which are pure media plays. Also, keep in mind, Apple has not done any major purchases in recent years, and its largest came in 2014 when it bought Beats for $3 billion. To buy Disney, the current market cap is nearly $180 billion. They would need to buy it at a premium, too, so they'd pay more than $180 billion.
Yeah. Correct.
Also, Warner Bros., they're at $37 billion, and Paramount's just over $14 billion. So, again, a fraction of the price, essentially, of Disney to get that same concept of getting content, getting studios. And I think that would be a far better strategic play for Apple than, again, going down Disney's path. Because, Disney obviously has been very successful with the theme parks and so forth, but Apple's been successful in very high-margin businesses.
Right.
And this is a whole new challenge for them to tackle. I think you're right. I think you'd have to spin it off, but then you'd kind of lose the magic of Disney, perhaps. And it's it's something that I would be shocked if that happened.
Yeah, and it'll make a lot more sense. So we said Warner Brothers. Paramount, $14 billion. That's a lot less than what they pay for Disney. And again, premium could be $28 billion, but still, Apple could do that if they want to. But even that will probably slow down their growth. But again, you can't have just cell phones forever. They've got to get into streaming. They got to do other things. That could make a lot of sense, buying a Paramount for $25 million, or billion, not million, but billion. Because what are they going to do next? They've got to do something next. You can't just keep doing what they're doing. Their growth will slow.
Well, and especially if the TV is something they're passionate about. One of my favorite shows is Ted Lasso. I think it's a great show on Apple TV. It's pretty funny. But it is produced by Warner Bros.
Yeah.
So I feel like if Apple wants to take that next step, it's very difficult to get IP.
Right.
You're almost better off buying the IP because it's going to take you years to establish that credibility and those brands. And, you look again at, Warner Brothers, they have, DC. Obviously, Disney does have Marvel, but obviously we talked about the premium you have to pay for Disney. But getting those types of assets, I think if they're interested in that space, is going to be difficult to accrue naturally.
And what the
organically,
and what the whole thing is that content, and to watch that content, because we want to be entertained. We want that. We want to be entertained with something new, exciting, fast, easy to get. And that, for me, for Apple, I mean, that would make a lot of sense because you've got the device in your hand. You got to put something on it for people.
Well, and the other thing that you look at too is Apple also talks about maybe perhaps gaming. And one thing that Warner Brothers has as well is they actually just released a Hogwarts game, and that has done phenomenal in terms of the people buying it and the demand for it. So you can actually create gaming content as well from the intellectual property, which is kind of a win-win as well for Apple. I'm going to say even if they bought Warner Brothers, I still wouldn't say Apple's a buy because it's too expensive, but. I think long-term, if it is a business they're interested in building, I think it's going to be very difficult, as I said, to do organically. I think an acquisition would be much easier, and I think there's much better targets than trying to go after Disney.
Yeah, and you're right. Apple's very expensive, but they'd be the acquirer, but maybe the company you want to buy is not Apple, but the companies they're looking at acquiring.
Yeah.
Warner Brothers, Paramount, I mean, what are they going to do? And you may be wrong. They may not do anything, but they've got to do something. They can't keep just coming out with an iPhone 25 now. Like, oh, big deal.
Yeah, I know. Because then they just have to keep raising the price on the iPhone, and that's the only way that they're going to get, earnings growth. And then you're trading at such high multiple that you still need earnings growth. And
then there's some of us that still have the iPhone 8.
Yeah, I think that's what I have.
Yeah, I think you have the 8.
And I got to say, my battery's starting to act a little crazy, though.
Is it time to go to the iPhone 9?
I think what I would do, I was talking to Harrison, our financial planner, and he's got the iPhone 6, so he's behind me. Is we talked about doing the iPhone SE, which is like, because I don't like the big phones.
I don't like them either.
It's just too much, and I like the size of my phone, and I think the SE is the same size of my phone, so that might be my next step. I think that's like $495, though, that I don't know if I want to part with.
We'll move on to Binance. Let's talk about some cryptocurrency here. There has been quite the week for Binance, which is the world's largest crypto exchange. You wouldn't know it from the price of Bitcoin because I think it's now still above $28,000, which defies logic. And I'm sure more people will get burned once again. The CFTC, known as the Commodity Futures Trading Commission, has charged Binance with operating illegally in the U.S. and violating rules to prevent illicit financial activity.
And billions of dollars have been walking out the door from the company. And as we said months ago, Binance would be the next crypto company to fall. And as these crypto companies continue to fall, I don't know how Bitcoin can stay at these levels, especially if Binance does fold.
Right.
And again, I think it's realistic that could occur. This whole idea of adoption for Bitcoin becoming wider spread is like, so these exchanges were supposed to make it easier to buy Bitcoin. And honestly, in the first place, I don't even understand why you need the exchanges to buy something like Bitcoin.
Right.
I mean, it's just, I don't know. That's my feeling is, ugh.
Right. And I kind of look at the exchanges. And again, you had FTX go. They're just falling by the wayside. And it did make it easier because the digital wallet that they have, and I'm not a crypto expert by any means, but you could lose your password. You could lose, not how to get it. All these problems you could have. With the exchanges, I think they made it easier for people, which people want simplicity. Well, if they go away, you're back to doing it the hard way again. And, who's going to be buying it? It loses the excitement is what I'm seeing. But,
well, I mean, the funny thing is it's almost like an oxymoron when you look at Bitcoin is, right now, I saw a headline on the news. Oh, Bitcoin rises as risk-on trade goes back. Well, Bitcoin was rising the other week as a counter to the banking system and,
right.
Stick it to the man. And, we don't need the banks, and it's going to be crypto. And the funny thing that I look at as well is these people that, go to these banks And then you know about the FDIC insurance. You know that it's $250,000. That's a pretty widespread fact that people know about. And then you lose money, and you're going to complain about it. Well, who in the heck is not going to complain if you lose money in Bitcoin then? All these people are going to, it's not fair that I lost money in Bitcoin. If Bitcoin were to go to zero, I bet you there would be a huge class of people that would want the government to be involved. And it's funny because what is the whole concept that Bitcoin is created on? To get away from the government. Right. But if it fails, people are going to complain and ask the government for money. It's just, it's stupid in my opinion.
Yeah, and it really is. It's just something that there's a group of people that really push Bitcoin, and you got enough people that's going to push it up, but there's no use for it. You bring up a good point. People lose money. Well, where's the government? How's the government come to protect me? Well, you bought Bitcoin because you want to get away from the government, but you want that protection. It's just, again, I still say it's a gambling chip. I will not do anything with it. We talked before about how things would fall. We're laying out the groundwork that things are falling. Binance, that's not going to happen. Now they look like they're going to have problems.
And the other thing I look at, and we've talked about Elizabeth Warren a decent amount when it comes to the banking system, and there are aspects that I definitely strongly agree with her when it comes to banking, and I think she goes overboard. But there does need to be safety in banking, and if you don't have that, it's really hard to have a society where you can lend out money and grow and have capital that's trustworthy. I mean, I'm all about good regulations and capitalism, but many times they go too far on the other side, I would say. But I was going to say one fact that has kind of been percolating that I've been thinking about is there's this concept of know your customer.
Right.
And you don't know your customer in Bitcoin, and it encourages this illicit activity. And I mean, if you are for Bitcoin, you're for child trafficking. You're for the Middle East kind of building up these mass weapons of mass destruction. I mean, you're encouraging this type of behavior because there's no way to know your customer in Bitcoin, which is a very dangerous path to go down, in my opinion. And it's hard to walk that balance, but I don't think morally it's a good thing either.
Right. And Bitcoin could go above 30,000. I mean, it's just a gambling chip, but there's no reason for it. If you're in it, and you made money, congratulations. But again, you're gambling. You go to Vegas, you make money as well. So, I mean, it's not going to be a stable currency. Someday things will collapse, and I think those days are coming soon.
Well, the thing I think is interesting, too, is, I mean, these people that are all for, going against the big banks, and I mean, one thing that I'm sure you've seen as well is Jamie Dimon's being deposed because Jeffrey Epstein was a client of J.P. Morgan.
Yeah.
And it's like they're going as far to say, know your customer, and it's like that is a huge stretch.
Yeah.
But, I mean, they want that type of regulation, which I think is, again, too far.
Right.
You can't know every single customer.
Right.
But you can avoid groups like ISIS and stuff and make sure we're not having them have money. That's kind of where I think regulation needs to walk that fine balance. But you can't have completely unregulated markets. It's too dangerous.
Yeah, people wanted them when it's going up. When it's going down, they want the government protection.
Yeah,
so
absolutely.
Well, we get this from our newsletter that we do, and if you want more information about the newsletter, because there's other topics we talk about this past week, and that was money market funds. We talk about the banking industry, L.A. real estate tax. God, that's one you got to read. Pending home sales, buy now, pay later, coming out from Apple, global trade, all these different things we talk about in the newsletter. It is a free newsletter. You can get it by simply going to our website, smartinvesting2000.com. That's smartinvesting2000.com. It's right in the middle of the page. Just click on it, sign up for it, and you'll get the newsletter 5 o'clock every Friday. And people love it because it's quick to read. You get great information out from it. Probably read it in 4 or 5 minutes. And topic there is say you don't care about Bitcoin. Don't read that section. Read the next one.
Yeah, so. I talked to a friend in Mississippi that I recently met actually on vacation, and he listened to the podcast and stuff now too. He's like, I asked him about the newsletter, and he's like, yeah, it's everything that I kind of wanted to learn about, and it's quick and easy. So
yeah, you can become a smarter investor in a very short time frame and have topics to talk. Go to a party that night on Friday night, you got something to talk about.
Maybe.
No, there's going to be something there for everybody. I think you want to talk about Bitcoin, you want to talk about money markets, you want to talk about banking industry, taxes. It's there for you. So again, at the website smartinvesting2000.com. That's smartinvesting2000.com. Well, Chase, I'm very excited. I think you are as well. This is now April. We're not excited because it's April, but we're excited because we have a workshop coming up on Thursday, April 20th at 6 o'clock at our offices in Scripps Ranch there. You're going to, how you should be investing now. I mean, this is a big concern for people. Should I be investing? Is a recession coming or not? We're going to cover that. Will there be a recession or not? We'll talk about that. And our price fluctuations keeping you from investing. That's very hard for people right now because we do have more volatility. So it is hard to invest. We'll cover that for you. And also, too, how proper financial planning can reduce your taxes. We got a great section on that for you. It is a free workshop. All you need to do is sign up for it. Go to our website, smartinvesting2000.com. That's smartinvesting2000.com. And that is for Thursday, April 20th, 6 p.m. Probably we say till 8. It probably goes about 7:30 with questions.
We normally hang around till like 8 just to answer any questions.
Yeah, kind of let you know how it goes. We probably speak for about an hour, take some questions. Then we wrap it up, and then we hang around because people don't want to ask questions in a public setting, and then we'll ask the personal questions afterwards. So we're probably there till 8 o'clock. But it's been doing those for years. So they're very helpful. We got some new information there to help you out, especially this time when you're kind of concerned about investing. This is the time you want the workshop. Again, it is free. Smartinvesting2000.com.
And I do want to piggyback off that too, is because it is so fun. This is a time where a lot of times people say, "I'm just not going to do anything." And they're kind of frozen. Or it works one of two ways. People will kind of say like, oh, I'm just going to go to cash and wait until, again, things settle down. We talked about why that's not the right thing to do. But another thing people do is like, oh, I'm just going to not look at my account. Well, if you don't know what you hold, as you kind of said, that's very dangerous as well.
Yeah.
So you got to, again, understand your portfolio and how it's being invested. And I think that's one thing we really pride ourselves on is we have a discipline, and we really convey to our clients what our discipline is so they know why they don't need to panic in these downturns. If you're just holding a bunch of different mutual funds and have asset allocation model, there might be reason to panic.
Yeah, that's true. And you said if they're not looking at their accounts, well, our clients, we tell them they don't have to look at our accounts because we are, and our money's invested the same way as our clients. So we're looking at our accounts. We know what's going on, and we don't look at the day-to-day movement. We're looking at the fundamentals of the companies we're investing in. So you don't have to look at your accounts if you are invested with Wilsey Asset Management because we are watching the businesses, not the day-to-day gyrations of the stock price, which means nothing at all.
Yeah.
So, all right, phone numbers. Totally forgot to give those out. So now we got no calls waiting. 833-288-0973. Again, that'll get you through for your unbiased, no strings attached, fundamental opinion about what you want to talk about. Again, 833-288-0973. 833-288-0973. Well, we got a couple of people here that sent us emails and called and so forth. One is a tool who lives in Chino Hills. He wants to talk about Kohl's, and I'm kind of excited about that because I know we did kind of well with Kohl's years ago, and we got out of it. They had some great things going on. It seems that all those great things they had are gone, so I'm kind of curious if maybe now it's time to go back into Kohl's. I mean, it is a big retailer. They do have now Sephora. I believe the contract is fully implemented where Sephora's in all the Kohl's. Is that done?
Should be. I mean, I haven't looked at Kohl's in depth in a few years now. So
have you been to Kohl's?
No.
I used to go to Kohl's. I don't go there any longer. It's a little bit out of the way. I did go to the one. I went by the one in Poway. I did see Sephora. It's a big thing there, and makeup is just huge. Sephora is owned by, and I can't say it. It's they own Louis Vuitton and the big.
Just LVMH is the ticker symbol,
Thank
and
you.
it's Bernard Arnault is the CEO. I think he was, and if not, is still the richest man in the world.
Yeah. That stock is way, way overpriced.
Yeah.
I looked at that like, woo, that's expensive.
Just like their goods.
Oh, yeah. And their goods have gone up a lot. And it's just like, wow, you go in the store like, well, you can't even get anything for $2,000 there unless you want a belt. You want a belt? Here, $2,000.
I got to say, too, about Kohl's, it's funny. I remember a year or two ago, somebody on social media kind of like blasted us because they knew that we bought Kohl's, and they were like, oh, yeah, what do these guys know? And it's like, oh, yeah, I knew COVID was going to happen.
Right.
And that's one thing that kind of happened to these department stores. It really changed the trajectory of the business model because it wiped out essentially a couple years of revenue streams.
Yeah, it really. And I didn't know that their CEO left, Michelle Glass.
We like.
She is now. She went to Nike, I think.
I'm not sure where she went.
I know she
Maybe.
Yeah, someplace
I'll
you
look
went. Yeah, look it up. I'll look at the numbers here again. We're talking about Kohl's department stores. Their symbol is KSS. They are in the department store industry. Wow, float is high, 23.4%. That's on the short side, so there are a lot of shorts there. We do see that 100% institutional ownership. They did report earnings on January 31st. Unfortunately, the first number, PE ratio, not material versus 18 for the industry. For the last 12 months, they have no earnings, which does surprise me because we've kind of been through the COVID situation. Price of sales, very inexpensive, 0.2 versus 0.4. Price to tangible book value does look good, 1.1 versus 7.3. And price of cash flow is expensive at 10 versus 6.2. Now, earnings growth over the past year and even 5 years, there's nothing there. The industry was up 18.8% for the past year. Sales for Kohl's did decline by 6.9% over the last year, more than the industry declined by 5.4%. The 5-year estimated growth for Kohl's, based on the earnings going forward by the analysts, a negative 17.8%. So that's not good. The industry is negative 1.8%. Wow, they do pay an 8.5% dividend, but they have no earnings, so there's no payout ratio, which means that dividend probably is at risk. You look at the cash flow statement, see if they're cash flow positive. I might do that when Chase is looking at the other numbers. We do see that the buyback yield is high, 26.1, so maybe they're buying back a lot of stock, which could be positive. But are they borrowing to buy that stock? That's a big question. Look at the balance sheet. Current ratio, 1.2. That's the same as the industry. Debt to equity has climbed 2.0 versus 1.8. I know when we had Kohl's, they would have not had that type of debt to equity. I think it's much lower. I think they borrowed a lot of money to keep going here. Net profit margin, a negative 0.1%. Industry, a positive 2.3. Return on equity, a minus 0.5% versus a positive 7.8. And return on invested capital, only 1.4. Gosh, you're not looking good here unless you have something major there, Chase. Not looking good.
Well, current price here for Kohl's, $23.54. 52-week high, $61.84. And a low, $20.90. I see year-to-date it's down 4.7%. Over the last 1 year, wow, down 58%. The 3-year return from COVID's not bad at 77.5%. But gosh, yeah, 5 years, negative 55.8. So, I mean, obviously with COVID, it's really disrupted this business. Also, did look at Michelle Gass. She is at Levi.
That's what it was. Yeah, that was a surprise to me. Yeah,
I was kind of surprised by that as well. But going forward, January 2025, they do report on a fiscal basis. The estimated earnings per share is $3.11. Looking at that $3.11 and using our 16.6 multiple, we get a target sell price of $51.63. It trades at a forward PE essentially of about 7.5 times. So it's great valuation. The only thing I would point out is how are they going to have that earnings growth? I mean, you got to understand the story behind that earnings growth because I personally don't know how they would get earnings growth, essentially.
Yeah, and I did look at the cash flow statement for the year. It looks like they were net cash from operations was a positive $707 million, which is actually pretty positive. Going back to January of 22 as 497. So that is one positive you can find for Kohl's. But and you did have good numbers going forward on the earnings. What was the range of those estimates? Do you have that?
Yeah, so it's $2.44 to $3.84. So it's a pretty decently wide range.
And I show 17 analysts, so that's pretty big. I just that's the only positive in the cash flow. Lot of debt there. I did see that their debt looks like it's increasing, not decreasing. Let me just look at that real quick. Sample the balance sheet.
And the other thing too, while you're looking that up, is we didn't hold it when the Sephora deals were kind of being implemented, essentially, or that was something they were talking about.
Right.
So I'm not sure how they're structured. Do they get a cut of Sephora sales that occur in the store, or are they just using Sephora to bring in traffic? Because it's like maybe people just go to Sephora and they don't buy anything at Kohl's, and it's not really helping them a ton. So that's something I would want to understand.
And that was one thing that I saw as a negative, because there's a separate entrance, this is in the Poway store, to Sephora. So you don't even have to go in the Kohl's store to get the makeup at Sephora, which I think was a big mistake, because Michelle Gass used to put the stuff in the back with Amazon. Remember Amazon? Yeah. You had to go in the back to get it, so you have to go buy stuff. Maybe I should buy that. With Sephora, you can go in and out, not even go in the Kohl's section. Now, that was just that one there. I think we did go one time No, maybe that was no. I think it was up in Escondido. I think we went to one, and it was kind of a small Sephora in the back somewhere.
Yeah, I just these department stores they do concern me because you listen to companies like Nike, like these other retail brands. Essentially, they talk a lot about D2C, which is direct to consumer.
Yeah.
They don't talk about selling to Kohl's.
Right.
They're trying to build their brand. And I think some brands also worry about being in a store like Kohl's as it could hurt brand perception.
Right.
So I just it's something that I ever since COVID I've been extremely cautious around because I don't like companies that don't own their own brands, because if it does go that route, and let's say Nike starts opening up more stores because like it's more profitable to open a small store rather than to sell to a Kohl's. I mean, that would really hurt the department store industry.
Yeah, I just don't see department stores being the way to go down the road. I did look at their debt. Their debt is up to over $7 billion, which is in the range. I see a low back in April 2020 was $6 billion. So not outlandish, but I just don't see the catalyst. Even though the numbers from the analysts look pretty good, I just don't see the catalyst of getting into Kohl's.
One last thought on it was I remember years ago when we held it, real estate was actually something that a lot of analysts pointed to as being a positive for Kohl's, as they actually owned a lot of it. That is something that could help with it, but I do worry if department stores aren't as profitable, maybe that real estate isn't as valuable as well. So
that could be. And where is that real estate located? And that's why I think there was like some corporate raiders trying to get onto it or something, and
And the thing I will say again, we kind of talk about this on the REITs, is it does kind of discount the book value. When you look at debt to equity, if they do own a lot of real estate, that's been depreciated via accumulated depreciation over time. It could have a higher market value, which would then raise the equity of the company essentially. So something that is a potential positive, but quite frankly, I'm not interested in the Kohl's. I'm not interested in the department store space. I don't think it's a place I want to be for investing, so not worth the research.
Nope, exactly. All righty, let's move on. Phone numbers here, 833-288-0973. That's 833-288-0973. Let's go out to El Cajon and speak with Joanne. Joanne, you're on the Smart Investing Show. Brent Chase, how can we help you?
Good morning, guys. Just wondering what your thoughts on InMode. The ticker sign is INMD.
Okay, and do you hold that or looking at buying it?
No, I'm curious. I'm looking to buy it because I hear about it from several different sources now.
Okay, well, let's take a look at InMode. Their symbol is INMD. They are in the medical devices industry. Float, about 6.4% on the short side. That's not too bad. Institutional ownership, about 58%. Not a bad start here. PE ratio 16.9 versus 114 for the industry, so that's a positive.
Oh.
However, price to sales 6 versus 4.1. Price to book value 4.8. That's very good because the industry's at 65, so that's another positive. Price to cash flow 15 versus 39. That's another positive. PEG ratio, which is your price earnings divided by growth going forward, 1.1 versus 6.2. The lower the number, the better, so that's a positive. Looking at the earnings growth, unfortunately, last year they were down 4.1%, but the whole industry was down 75%. Sales did climb over the past year by 20.2%, but yet the industry was still down a negative 1.4%, so that's a good move there. 5-year growth rate estimated by the analysts, 12.5%, just slightly under the industry at 14.4%. And I do like this industry because I think medical devices is going to continue to grow. Unfortunately, they do not pay a dividend. Looking at the balance sheet, got a current ratio of 7.7 versus 2.4. Now, that shows a lot of liquidity. It does make you kind of question, like, hey, guys, you got a lot of liquidity there. Can't you invest this money and get a better return than maybe, the 3 or 4% you're getting? So that's one thing I always see when I see a current ratio above 3 or 4, I really start questioning what management is doing. And then looking at the net profit margin, very nice, 35.6 versus 4.4. Return on equity, 29.1 versus 12. And return on invested capital, 32.4 versus 6.6. So I'm kind of liking what I'm seeing. It depends on what you got going forward here, Chase.
Yeah, well, so looking at the company, they do provide, it looks like here, minimally and non-invasive surgical, aesthetic, and medical treatment solutions in the U.S. Solutions address 3 energy-based treatment categories that include face and body contouring. I'm not quite sure what that is. I think I've heard my wife talk about it.
She's so young, she doesn't need that yet.
Medical aesthetics and women's health, which I think are all pretty prevalent in today's society. So I think it's kind of fitting a good need, and it looks like it's used. Its technology is used in plastic surgery, dermatology, gynecology, and I don't know what that word is. Ophthalmology. I'm just not going to say that one. That one was too hard. But it seems interesting for sure. And when I look at kind of the current price for the business, I mean, it's at $31.96. It is off the 52-week high of $41.84. It has climbed off the 52-week low of $20.60, but I still see here year-to-date it's down 10.5%. So it has had a little bit of a pullback. But the thing that's quite intriguing to me as I go out to December 2024, I do see estimated earnings per share for this business at $2.97. Gives us a pretty decent target sell price here of $49.30. Essentially trades at a forward PE of about 10, 11 times.
And I think I have seen this product in my doctor's office. And the non-invasive means, I guess I don't do cutting or something. And it seems to be growing. And we know that the beauty industry is doing extremely well. It's very resistant. There could be something here, but I want to understand more about it, because one thing when I see those brochures, I always wonder, does it really work, or is it more of a scam? And I got to say, Joanne, I think it's worth the research, because this could be a boom company if what they do really does work.
I mean, you're getting good valuations on it. Growth this year's estimating about 7.5% on earnings. Next year's estimating about 14% on those earnings. So you have good growth here, good valuations. Number of analysts, there are just 6. It's about a $2 billion market cap, so it's a little bit smaller. I'm okay with 6 analysts. It doesn't excite me to have that many, but I'm okay with it. Especially when you look at the range of those, it's $2.95 to $3, so a pretty darn tight range there. I mean, I'm going to say it's intriguing.
Yeah. I kind of like this because this could be something going forward. I wish the market cap's a little bit higher. I think it was like about $3 billion, which is not small, but it's not big. We'd like to be a little bit bigger. But Joanne, I think you may have stumbled across something here that could be worthwhile looking into, because I like the industry. The numbers look good. The only thing that worries me is that, will this be something that, it really didn't work, and people spend thousands of dollars, and because there's so many things out there in the field to fix your face, and then you find out, that theirs really didn't work, and then there's lawsuits and everything else. So
to fix your face.
Well, okay, not to use some terms, but people trying to look younger, get rid of the wrinkles. Hey, you're not there yet. I got the wrinkles. I know what they're talking about. So Joanne, I think it is worth looking into it, because it looks pretty good. It could be good. All righty?
Thank you very much. Appreciate it.
You're welcome. You have a good one.
All right, you too.
Bye-bye. All right, that does open the phone line, 833-288-0973. That's 833-288-0973. Should I use the word enhance your face? Would that have been better than fix your face?
I'm just going to leave it at maybe plastic surgery.
Okay. Let's just move along, maybe. Okay.
Fixing your face, enhancing your face means your face looks bad. So.
Aging is a big thing. We all want to look young. You don't know that. It's your birthday today.
I'm 30 now. Hey.
I know. Yeah, your wrinkles are really showing. Be careful there. All right. It's time to talk to our financial planner, Harrison Johnson. So let's go to Harrison and talk about California Down Payment Assistance Program. Harrison, what are we talking about here?
Hey there, guys. Happy birthday, Chase. 30th birthday on this April Fool's Day.
Thank you.
So, this in the last few weeks, I've talked about buying versus renting, and also companies that offer shared equity agreements to help make down payments. So today, this is another twist to all that. This program, it's called the California Dream for All Shared Appreciation Loan. It launched this last Monday, so it's brand new, and its purpose is to help Californians make down payments to buy houses. So the way it works is you can essentially borrow up to 20% of the purchase price of the home from the state to make your down payment. Once you do that, you don't have to make any payments on this down payment loan, and it doesn't accrue interest. You still have your normal mortgage, but on just this down payment part, it doesn't accrue interest, and it doesn't. You don't have to make any payments on it. And then When you sell or refinance the home, you have to pay back the amount you borrowed plus 20% of the appreciation of the home. So let's say you buy a home for $750,000. You can borrow 20% to make the down payment. That's $150,000, and then you get a conventional mortgage for the remaining $600,000 purchase price. And then if you sell the home in the future for, let's say, $1 million, you have to pay back that original $150,000 that you borrowed plus 20% of the appreciation from $750,000 up to $1 million. So that's $250,000 appreciation. 20% of that is $50,000. So the total repayment is the $200K, or $150 plus the $50, so $200,000, and then the remaining equity that you have is $200,000 plus whatever you paid your mortgage down by. So to be eligible for this, you have to be a first-time home buyer, which is kind of a technicality because all that means is you can't have owned a home in the last 3 years. You can only do this for a primary residence. You have to complete some home buyer education counseling, and you have to meet the income limits, income limits are by county. And in San Diego, your income has to be less than $211,000, which is not a small amount. And then also, if your income is below around $85,000, then your shared appreciation is only 15% instead of 20%. And then this program has to be paired with a Cal HFA Dream for All first mortgage. So the first mortgage has to be part of this. You can't just go to any lender to get a loan. And then lastly, they can be for single family, one unit residence, condo type stuff. You can't use it for duplexes or triplexes or anything like that. So how does this program compare to the other shared equity companies out there? Because there's companies that do this. A few weeks ago, I talked about a client that was stuck in one and how bad it was. And the main difference is the companies that do this take a much larger percent of the appreciation. Usually it's like 50% or more. In this case, it's 15 to 20%. So it's not nearly as bad as those companies are that doing that. And then as far as this program compared to buying normally or renting, well, if your property value goes down, then renting makes sense, and that's the only thing. In this case, if you buy a property with this program and it goes down, you're immediately underwater because you're essentially borrowing 100% of the purchase price of the house. If property values stay the same, then there's no appreciation, so you don't have to essentially pay anything to have that down payment loan that you have. You still have to pay the loan back, but there's no extra amount that you have to pay back. But in that case, you're still paying the regular mortgage, the taxes, the insurance, the upkeep, all that stuff. And then, so in that case, you're still most likely better off renting because your monthly cash flow is less. And so really the best case scenario is you use this program, the property goes up a lot, in which case, you get some appreciation, but now a big chunk of that you have to give away when you refinance or sell the home. So overall, I think there are some applications where this can make sense, but in most cases, I think either buying normally using your own down payment, even if it's less than 20%, or renting is still going to, be a better option for you long term.
And I can see problems with this as well. And the government tries to do things to help people out, but I just don't think they think it through. I can see somebody kind of forgetting about it and, let's remodel the house and let's spend $50,000. Let's get a line of credit, which I'm assuming they could maybe still go to the bank to do that. I don't know if we prevent it from doing that, but they do that. They borrow $75,000.
A lot of banks don't like to issue additional loans on this because there's, when you get a loan, you're using the equity as collateral, where in this case, the collateral kind of depends on what the appreciation is. And so a lot of times if you have one of these things on there, you can't just refinance the first mortgage that you have. You have to do both.
And you can't take a second out from them either, because that would be a positive. Because what I was going to say, and maybe somebody can take money from somewhere else, put in $50,000, $75,000, remodel the house. Well, they made the house appreciate more, but at the end, the state's going to get the 20% appreciation. They don't care that you put in $50,000 or $75,000 in the house. So I just don't. I don't like complicated things.
I'm going to tell you, one of the words the government loves, predatory. I just have nightmares of this 15 years from now about how the government was predatory lending, and it's not fair that people have to give up the appreciation on the property even though they forgot about it and forgot about the rules and so forth. And I just see this being a disaster years down the road, and people saying it's not fair. Because, while I don't think real estate's going to do well over the next 5 to 10 years, I still think over the next, let's say, 15, 20 years perhaps,
it will go up.
It's going to go up. Well, I think people are going to be pissed off down the road, and they're going to forget the deal. I mean, it's just like people complain about high interest rates on credit cards. Who doesn't know that credit cards have high interest rates? It's just... I think this is going to be problematic.
Or I borrowed money for my student loan. I shouldn't have to pay it back. So I think you're right, Chase. I mean, that could be a problem. And the government, I thought the government didn't have any money. Where are they getting the money from? So and Harrison, it's so good you bring this up, because these are things when it comes to financial planning that people don't think about. They get excited about, and it is very exciting to buy a house. But you really got to think through the numbers, because you could be having it be the best decision you made in your life or the worst nightmare you ever came across. So,
yeah, and I think, everyone always says that, well, especially in California, property values are so high, it's so hard to make that down payment, which, it's true. In a lot of cases, down payment's really high. But if you're someone who is renting and can't get enough to make the down payment, even if you had the down payment, I think it would still be a challenge to make the monthly payment as well, because when you transition from renting to buying, your monthly payment could double or more, even if you had the down payment. So it seems like to me, in a lot of cases, if you're renting, maybe don't live in a luxury apartment, maybe live in a normal apartment that's a little bit cheaper, try and save up some money and then use that to make your down payment. Because that proves that you can save that difference. And then when you do buy, you have that cash flow that you can allocate toward the home. And then you want to do that in a time where it makes sense to buy, where you get that appreciation. Because again, in last week, we said it really only makes sense to buy a house if you are going to get that appreciation to make up for the extra cash flow that you're putting into it. And so, like I said, there might be some people that can benefit from this, but it just makes things complicated. And, buy a house for $1 million, it goes to $2 million. What? I have to give up $200,000 in my appreciation, but I put a $100,000 remodel into this. Yeah, well, you also paid all the property taxes. You also, paid all the property insurance on that, and you only get a portion of the appreciation. So you really got to understand the numbers. But again, this is brand new, just launched on Monday, and the state is allocating $300 million for this that they expect to help around 2,300 transactions. So it's something new that's out there.
Well, Harrison, this is why people need a good financial planner to go through these things with them. Thank you very much. You have a great day. I know you're enjoying the celebration with Chase today, so we'll see you guys. We'll see you on Monday. So have a good one.
All right. Thanks, Brent. We'll see you Monday.
All right. Again, there's Harrison Johnson. He is our financial planner, CFP. He is on a salary, does not sell you annuities or life insurance to make money. He does not sell any product. He is a fee-based financial planner. If you want to have a consultation with him, call him at the office, 858-546-4306. That's 858-546-4306. Or go to the website, smartinvesting2000.com. That's smartinvesting2000.com. I do see we got Val in San Diego. Before we go to Val, I want to talk about the workshop because it is coming up. It'll be before you know it. It's April 20th. And we'll talk about how you should be investing now because that's what's kind of scaring people. Will there be a recession? Will there not be a recession? We'll talk about that and show you how to invest during a recession or without a recession. We'll talk about that. Are price fluctuations keeping you from investing? I know it's a hard time to invest, but if you have something to hold on to and you understand why you're investing, you don't worry about the emotional side. You've got something concrete to build a good portfolio. And then also, too, you just heard from Harrison Johnson how proper financial planning can reduce your taxes. That's an important thing. It gives you more money to invest. So that is going to be Thursday, April 20th from 6 to 8. There is no cost for the workshop, but you got to sign up. Go to our website, smartinvesting2000.com. That's smartinvesting2000.com. All right, phone number is here, 833-288-0973. That's 833-288-0973. Let's go to San Diego and speak with Val. Val, you're on the Smart Invest Show. Brent Chase, how can we help you?
Yes, I am interested in Vermilion Energy. It's a Canadian energy company, mostly in oil, and the New York Stock Exchange symbol is VET, V-E-T.
Okay. And Val, do you hold that or looking to buy that?
I have had it before, but I got out of it because it was dropping, and I'm thinking of rebuying.
Okay. All right. Well, let's take a look at Vermilion Energy. Symbol is VET. They are in the oil and gas E&P industry. We do see institutional ownership very low, 34.7%. Nothing short on the company. PE ratio only 2.3 versus 5.7. Obviously a low industry PE, but even lower for the company. Price to sales looks good, 0.8 versus 1.6. Price to book value also 0.8 versus 4.5. Price of cash flow checks in at 1.6, about half the industry at 3.7, and a very nice PEG ratio of 0.2 versus 4.3. So valuation ratio is looking very good here. We do see earnings per share up 40% over the last year, but the industry was up 85%. Sales for VET were up 39.2 versus 37.2. 5-year growth rate shows at 20.9 versus 4.5. So all that's looking pretty good. You do see a dividend yield of only 2.3%, but they only use 5% of their earnings to pay that out compared to the industry using 32% of their earnings. Look at the balance sheet. Current ratio 0.8 versus 1.6. That's a little bit low, but I'm okay with it if you check the debt levels a little bit more and their cash flow. Debt to equity is 0.3 versus 0.7. That's a positive. Net profit margin 35.3 versus 28. That's big. And then also, too, return on equity 38.6 versus 32.6. So I like what I'm seeing here, but I'm going to be very curious what you have to say going forward, Chase, because I know it's the energy industry here.
Yeah, just real quick, too, on that quick ratio, it's 0.5, and quick ratio excludes inventory from it. And I worry if they can't liquidate the inventory at good prices, and that could be a problem. So
that inventory is obviously I'm assuming in oil, but I think oil is pretty low. It's around $70 a barrel. It's not like we're talking 100. So yeah, I see your point there.
Yeah, it's just something to keep an eye on.
Yeah.
Current price, though, for VET, again, Vermilion Energy, $12.97. Yeah, definitely fallen there. The 52-week high, $30.17, and the 52-week low, it's $11.93. I see year-to-date down 26.3%. It's, what I'll call like a mid-sized company with a market cap of $2.1 billion. If I go out to December 2024, though, I do see estimated earnings per share here. Wow, $3.24. That would give us a target sell price of $54. Is that right? Did I type that in correctly? Yeah, I mean, that's a $53.78 is the target sell price. I mean, that's huge and at a forward PE of about 4. I mean, it's definitely the valuations are there. I will say the estimates are kind of all over the place. As the low is $2.40 and the high is $4.49. There are just 4 analysts as well. Mm-hmm. So I again, 4 is kind of pushing my comfort level in terms of the number of analysts. I will also say it's interesting, and this year they're estimated to have earnings decline by 44%. So that's a red flag that I'd keep an eye on. But again, the valuations are definitely intriguing. I just would want to know a lot more about this company, as I think it could be very high risk.
Yeah, and I think it's worth looking into because, again, you got good valuations. You've got a reasonable dividend. They're not using much to pay that dividend. Oil is not high at this point in time. I think it's a fair price now. I think it's worth a research, and I have a feeling we're missing something. I don't know what it is, but Val, that's why I want to look into it, because you hate to say, yeah, everything looks great. Brent and Chase said numbers are great, I buy it, and then we miss something because, again, before we buy a company, it's 10, 15, 20 hours of research because we want to understand that business completely to make sure we're not missing something.
I mean, it's something trading around 4 times earnings. The saying, if it's too good to be true, it normally is.
Yeah.
I would say normally. There are exceptions. There are going to be times where it's like, geez, this thing is trading at 4 times, and that's a huge opportunity. But there are other times, there's a reason it's trading at 4 times earnings. So I would want to look for that reason. What is going on with this company? Because it's, in my opinion, too low of a valuation.
Yeah, and could there be a lawsuit? Could there be something going on with it? So you want to understand it before you get into it, because there could be, something going on that we're not seeing in the numbers. So, but I got to say, worth the research there, Val.
I think the missing element may be this. they were forced to pay a huge windfall profits tax in Europe, which they did pay off. But it is that huge profit tax in windfall profit tax in Europe that depressed their earnings recently.
See, now if they depress
I don't know if of anything besides that is a dark element in their future.
And thinking through this, you said they paid that, it depressed their earnings, but they still had a PE ratio of 2.3, so that would be high earnings there still. So that's something they did, but it's just a PE of 2.3 means you get your money back in 2.3 years. That's just unheard of. So, but worth the research.
That's the reason I'm looking at it again.
Yeah, yep. Well, and that's what you do because, and again, when we buy a company, we'll go through our research, looking. If we can't find any reason not to buy it, we'll buy the company. I'd say the same thing for this one. If you look deep in the research, if you can't find a reason not to buy it, it could be a great buy.
Well, and one other thing.
Well, I like to combine fundamentals with good, solid, I'm a mathematician, technicals. And I'm nimble in the latter respect. Yeah. If something is good, I will look at it, but I will look at it only if it looks good technically. And right now, it is kind of on the borderline.
Yeah, and I would say one other thing before I let you go there, Val, is just with the windfall profit tax, if it happened in the past, I worry it could happen again in the future.
It could happen again.
Right.
Right.
Well, Val, good luck.
Okay, thank you, gentlemen.
You're welcome. Thanks for calling. Good luck there. Bye-bye. All right. Gosh, this show just flies on by. I mean, it just goes by so quickly. But I do want to talk again about the workshop because it is going to come up. And we only do like 4 of these a year. So if you say, gosh, what do these guys look at? What does that mean? Where do they get that from? That's what the workshop is about. We only do, again, 4 years. So we'll do this one in April. Probably the next one won't be until probably July or something. It is a free workshop. Goes for probably about 60 to 90 minutes. You learned a lot in that workshop. We do have this time, too, Harrison talking more on financial planning, reducing your taxes. That's going to help you out as well. So there's a lot of information you'll get there. And I've been doing these workshops for many, many years. No one's ever said, I didn't learn anything, because we do give you a lot of information there. If you love the radio show, love the newsletters, you've never been to a workshop, you're wondering how we manage money, that's where you want to go to the workshop. Go to our website, smartinvesting2000.com. That's smartinvesting2000.com. You'll see it right there under. Do we have a workshop tab there? I think we do. Right in front, isn't it?
Sign up for our workshop. It's right at the top of the page.
Can't be any easier than that, can it? Yeah. So you'll sign up there, and and I think you'll have I don't want to say a good time, but you'll learn a lot. And you'll see what we do, and you'll see why we've been successful here in San Diego managing money for, gosh, I've been doing this now for over 40 years.
I was going to say, well, gosh, we always have a good time. I don't know what you're talking about.
well, I don't want people to think like, oh, this is
not a party.
Not a party, yeah, but it's a good time. We make finance as much fun as possible because it is a dry subject, but we do make it fun, and I think earning money, is good on your investments. I mean, that is exciting. What am I talking about here?
It's fun to me.
Yeah. It's something that does work very well. And we'll show you all that. And again, what's great, too, is I get to ask questions, in-person questions. As we said, we'll take questions at the end. We do also hang around a little bit afterwards saying, if you want to come up and talk to us and talk to you, me, Harrison in person, and talk about their personal situation, what they have that they may not want to bring up. So, again, it's a free workshop, a lot of information, and I guarantee you, I can't give any guarantees, I guarantee you there's no place else you can go and get this type of information in a workshop. It just doesn't happen. Somebody's going to go out and try to sell you annuities or sell you, life insurance or something. We don't do that. Go to our website, smartinvesting2000.com. Well, there's a closing bell. Thank you for listening to the Smart Investing Show. It is for informational person only and should not be used as investment advice. If you'd like to discuss in more detail your investment needs, have other investment questions, feel free to call myself, Brent Wilsey, or Chase Wilsey at 858-546-4306. That's 858-546-4306. Or go to our website, smartinvesting2000.com. That's smartinvesting2000.com. A lot of great information there. You can contact us there, sign up for the workshop there. So, again, smartinvesting2000.com. Thanks for listening. We'll be back next week right here on the Smart Investing Show.
I did all that, and may I say,